Markets off day's low, however, still under pressure. Sensex marginally above the 71,700 mark, while Nifty trades below 21,750. Sectoral indices trade mixed, with media coming out as the top gainer, led by Z Entertainment, while financials under pressure. Bajaj Finance shares dip over 4% in early trade on the back of Q3 numbers. Company's consumer finance business saw elevated losses. And more earnings on our radar. We have L&T, Bajaj Finserv and Dr. Reddy's that are expected to come out with their Q3 numbers today. Post giving a big thumbs up to Adani Enterprises, Cantor Fitzgerald now see a likely demerger of Adani's airport business, and this is after completion of Navi Mumbai Airport.
Hello and welcome. This is Hot Money. I am Agam, Vakil, and with me is Hiral, Dadia. And in this show, we take you through all the stocks which are buzzing in trade. At the moment, we are seeing a lot of strength in the markets, but before I address the markets, when I talk about KPIT Tech earnings which are coming through, well, they seem largely in line with expectations. We have seen a little bit of an uptick when it comes to your revenue number, currently standing at around 1,257 odd crores. On the other hand, when it comes to profitability, that is also looking at a sequential uptick, standing at around, right, so that stands at around 156.7 crores against 141 odd crores. It's certainly an improvement, but remember that KPIT Tech is one of those counters which has run up substantially over the course of the last 12 months. And for good reason too, because if you consider the year-on-year basis numbers, and if I'm looking at the 9-month numbers right now, we are looking at well over a 40% growth on a year-on-year in terms of revenues. And profitability also comes through. Remember, this is with the backdrop of a lot of changes economically, challenges economically when it comes to markets in the Europe as well as the US. We have seen this particular company scale those, challenges, and we are looking at fairly steady numbers, on the back of which we have seen KPIT Technologies now turn into the red from, trading marginally in the green. But to a certain extent, all the positives had been factored in, and I reckon a lot of questions will be about what the way forward is, especially when it comes to its premium clientele, which would, of course, include something like an Audi and a BMW. Hiral.
Absolutely, and a clear competitor comes in as a Tata Technologies, right, for KPIT as well. So both of these comparatives interesting. But now KPIT Tech absolutely in the green, seeing gains of over 1% as we speak since the time Agam started addressing it. But moving on, you have a RR cable that is in focus as well on the back of numbers. Let's pull up that counter. Revenues have seen a growth of around 10%. You have seen a dip on the margins front as well as a mild dip on the profitability front. The stock is down almost 3.5% to 4% in trade. Rajesh Jain, CFO at RR Cable, joins in. Rajesh, good afternoon and welcome to the show. If you could help us understand, firstly, have the numbers met your internal expectations, and what has worked and what has not worked this time around?
Good afternoon, Hiral, and thanks for inviting us on your channel. So if we see this quarter and if we see company as a whole for this nine-month performance year-on-year basis, overall, we have achieved the volume growth of 20%, which is like in expectation or in projection, in line with our projections. And when this industry is growing at 13 to 14%, we are able to have the volume growth of 20% year-on-year basis on 9-month basis, which is good. And even in FMEG, which is contributing 12% in our overall business, that is also growing at the rate of 20%, while that industry is hardly growing at less than 10%. And other players are struggling even to maintain their last year sales figures. So in that way, whatever we have expected, though if we see only this quarter, then there are some figures are not as per the industry estimates, but overall we are in line with our estimates and our plans.
Rajesh, morning. This is Agam here. My question is to do with your operating margins at the moment. You know, I do look at a decline on a year-on-year basis for the quarter, but on a 9-month basis, we are certainly seeing an improvement and expansion in your EBITDA margins. My question really is that if we are looking at a contraction for just third quarter, is there a likelihood that that could perhaps spill over to the upcoming quarters as well? And also, if you could perhaps elaborate why there is a contraction in the third quarter?
Very rightly said by you. If we see only this quarter, then of course there is a decline in our margins. But if we see on a year-on-year basis for 9-month basis, then there is good improvement in our margins. And again, this is in line with our planning or whatever estimates we have given that we aim to improve our margins by 140 bips. And as per our current estimates also, we will be able to achieve our yearly figures, whatever we have planned. And only for this quarter, yes, there was some impact due to you see, we are in copper wire and cable industry where copper prices also play some role. And there is always a time gap between passing on the prices to our consumer. In this quarter, we have seen copper prices have gone up by almost 5%. And majority of the part have been passed on, but in next quarter, again, this will be recovered, and we are expecting we will be able to gain the margins what we were having in first half of this year.
Right. Overall, Rajesh, I do understand, how copper prices have been impacting it. I think that's one of the reasons why we are seeing that translation on the top line as well. But overall, with regards to where the demand in housing and construction goes, how is that coming across? And in terms of contribution, how much is that helping, or adding to your revenues now?
So in our case, like 70% of our revenue comes from wire and only 30% comes from cable. And we have seen very good demand, particularly in tier 3 and 4 cities where we have the major our customer base. And it seems that real estate industry, housing sector, and renovation sectors is doing good. And we expect it will keep doing good, backed by government support, because government is also aiming good infrastructure development as well as housing for all. So we expect this will remain good in short to long mid-term time frame.
Right. Rajesh, could you give us an idea about whether or not you guys will be cash flow positive, net cash flow positive by the end of the year? And I ask you because I want also a little bit of a backdrop in terms of the capital expenditure that you have in fact planned for this particular year. Your view on both these aspects.
So overall, we are already cash positive company. If we just particularly see our FMEG, of course, we are having some losses in that. But at company level, already we have positive cash flows. And we have planned capex of 500 crores in this 2 years, which is FY24 and 25. And this all will be met through our internal accruals. And this is going as per our planning, and we have enough cash in hand.
Right. What's the plan with regards to the FMEG segment? Because that's still around 11% contribution to your revenues. So overall, the plan there, and in terms of capacity utilization, where does it stand for both the segments, and how are you looking to scale?
So FMEG, again, our base is a little bit smaller in compared to others, but still we are growing 20% in this year also, where industry is growing only 8%. And even going forward also, backed by our R&D and new product introduction in market, we are quite hopeful to achieve the growth of more than 20% in coming, at least in coming next 2 years. So FMEG will be mostly in next year, it will be EBITDA positive in FY25. And if we see capacity utilization, already we have very good capacity utilization in our wire and cable business, where in wire we are at 65 to 70%, in cable we are at 80 to 90% capacity utilization, which is quite healthy looking to the product mix and industry standards.
Okay, Rajesh, we'll leave it at that. Thank you so much for joining us and taking us through the quarter's numbers as well as the outlook. Well, that's the management of RR Cable telling us about all that is in store, not only for the quarter, but also for the upcoming year. And with that, we slip into a short break. But on the other side, we talk about stocks and a lot more. Stay tuned in.
Welcome back. You're watching Hot Money. Now, a couple of stocks that we will be discussing in today's day is Bajaj Finance, ITC, as well as Orchid Pharma. And you have some updates that we will take you through with regards to where the Zee-Sony merger goes. Let me welcome in our guest as well. Sharmila Joshi joins in to give us her view with regards to all these counters. But let's start with Bajaj Finance. They did come out with their Q3 numbers. Now, they've reported a jump in terms of profitability as well as the top line. However, the asset quality has actually worsened. Harsh joins us with the key takeaways. Harsh, what have you been picking up with regards to Bajaj Finance, which is causing this kind of pressure?
Well, yes, it's predominantly asset quality, Hiral, as you correctly pointed out. And within that asset quality, within the products, it's the B2C which is causing some amount of pressure, especially on the rural side of things. So where your loan losses are concerned, they've gone up by around 20% on a sequential basis. And that too on a low base of Q1. So Q2 saw an uptick over Q1, and now we've seen how Q3 has played out, an uptick over Q2 as well. And, you know, within rural, of course, what Bajaj Finance has done is they've calibrated growth in this quarter. So growth in rural has come down is what they're suggesting. But overall, within the other products as well as within the new products launched, growth is extremely solid is the commentary that's come through. And they're expecting that to continue. On the urban B2C side of things as well, there's been a bit of a slip up. Now, of course, the management continue to suggest that it's basically a normalizing of credit costs that's been happening off a low base. And when they're comparing that to pre-COVID levels, it's largely still below pre-COVID levels. So they are not suggesting any concern on the urban B2C side. But again, they've calibrated growth there as well. So the sense is it's asset quality that's in focus, what markets are really focusing on. What brokerages have done is they've toned down some of their expectations by 1 to 2%. They've cut target prices. We've seen across brokerages largely, they've just cut target price by 1 to 2%. And because they're seeing that slight spike in loan loss provisions, they've cut on their PAT, which has basically led to a reduction with regard to the target prices. But otherwise, it's a buy overweight kind of rating that we've seen.
Right, so that's with regards to Bajaj Finance. In fact, Finserv will be reporting numbers as well today. Sharmila, how are you looking at a Bajaj Finance and in turn a Finserv that will be reporting numbers today?
Well, I think, what we were listening to just now, I think that is the key takeaway for the entire banking and, related numbers that we've seen. I think ever since HDFC Bank numbers came out, market has been very NIM focused, and it has been focused on what your cost of loans are and how it's, your growth is going to be going ahead. Because I think there was a sense that perhaps from a valuation perspective, a lot of these stocks were trading on the higher side. And if you perceive for any reason that growth is going to slow down, then, this kind of correction is what we've seen across the space. Having said that, I think that the kind of numbers that Bajaj Finance has given are pretty good. And yes, they did have concern over, RBI raising concerns over those two cards, and they have said that they are going to write to the apex body about that. So all things considered, I think, if you ever been wanting to buy the stock and been holding yourself back because the valuations look stretched, I think this could give you an opportunity to enter the stock. So it's a stock I like, but yes, I take, the market's view is, I completely stand by that you really need to be focused on what growth is going to be ahead and at what cost.
Right. So that's with regards to Bajaj Finance. Let's just quickly pull up a Zee Entertainment on the screens. Now, the shareholder spree has actually prompted NCLT hearing for the merger execution. And NCLT has gone ahead and now rejected Sony's argument on the MCA clause. What NCLT is saying is that they take responsibility for deciding the clause satisfaction so far. These are a few of the lines that we are picking up so far in terms of where the Zee-Sony saga is concerned. In fact, there is a special hearing in Singapore, tomorrow as well. So that's one of the reasons why the stock was seeing some smart moves. If we can just pull up our intraday chart of Zee Entertainment to see, because the stock was up 7.5%. Some bit of cooling off has come in on that one as well. So that's with regards to where Zee Entertainment goes. And a couple of lines with regards to where the FTA trade talks go. The sources are indicating so far that, I mean, you'll see this, that the EFTA trade talks will be concluded soon, and they are aimed at prompting manufacturing domestically. Now, the talks include ways to enable Swiss companies to manufacture in India. This is going to be interesting with regards to where the trade talks are concerned, absolutely, from here on, Agam.
Right. Well, that's, of course, several updates coming in from there. But another update coming in from the pharma space from a relatively smaller pharma name, and that's Orchid Pharma, which has, in fact, hit an upper circuit after its new antibiotics drug gets authorization from the European medicine agencies. Well, we have Varsha to explain to us what the implications of this approval is for the company. Varsha?
Hello guys, so we've just received an exchange filing wherein European Medicine Agency has recommended granting marketing authorization for a product called Exblifep. Now this is used to treat adult with urinary tract infection and hospital-based pneumonia. Now, if you see the overall effectiveness of this product is 79% versus 58% of the other product that is currently into the market. Now, how this benefit Orchid Pharma is this novel antibiotic product is made by Orchid Pharma, and if you see companies expecting global commercialization by FY25, and also company holds marketing rights in India and worldwide royalty sales right. Also, if you see, they expect this royalty revenue to directly flow into their bottom line. And Alkera Therapeutic, which company is in partnership with, has completed phase 3 trial in US and EU, and they are expecting approval in the current year of FY24.
Varsha, thank you so much for getting us that update. Sharmila, do you track Orchid Pharma, even if it's not on your radar, your view, and perhaps some opportunities in the sector?
Well, of course, I think the news is good, but and again, the numbers were good, and it has a stock that is, I think, over the last 4 or 5 years, really rewarded investors well. Having said all that, I think the valuations look a tad expensive at this point in time. So, that's the only caveat. I think if you buy at this level, then you should, anyway, it's on a circuit, so today is not the recommended day. But when it's sort of the stocks is open for trading again, you can take a view, but bear in mind that the valuations are high. And the news, of course, as was spoken just now, discussed just now, this obviously is good news for the company. And given that it's not a very large company, this could be significant.
Right. Well, we've run out of time on this particular segment, so I'm going to take a moment to thank Sharmila for joining us and discussing that short list of stocks that we've had. But we also slip into a short break, and on the other side, we get you another management. Stay tuned to NDTV Profit. Welcome back. Well, Mahindra Logistics also came out with their third quarter earnings. The company's revenue went up by as much as 5%, but their EBITDA margins declined. We spoke to the management about the quarter gone by and also the pressure on operating margins. Here's a slice of that conversation. Listen in.
The losses were largely because last year we did not have the impact of the Reddy acquisition. And that essentially was the large delta in terms of earnings. In the quarter, we reported, 33 crores of losses in the acquisition of in the business which is the express business, which was acquired from Reddy. And excluding that, our earnings were actually pretty stable. We saw some impact in our core 3PL business because of seasonal patterns and new project launches. And most of the other businesses actually showed improvements on a year-on-year basis. So, so it's really one big challenge which we have had from an earnings perspective, which impacted that.
Okay, but on the cost side also seemingly there was a little bit of pressure. Is that right to assume? And can you talk about some of those pressures spanning forward as well?
So I think the 3PL business really saw some seasonal impact. We did see, during the festive season, we normally see an increase in labor charges or labor costs. And we did see a sharp spike during this quarter on account of that. We also had several new projects which got launched towards the end of the quarter, and we had startup costs which are on account of those new launches. Excluding those, things were generally, there were no real cost challenges. Those will tail off in this quarter. They are more a one-time or a quarterly phenomenon rather than a continuing factor.
Well, and on that note, it's a wrap on this edition of Hot Money. But on the other side, we get you a lot more. Stay tuned to NDTV Profit, and we'll keep bringing you more.
Well, thanks for tuning into this special show, Budget 2024, the takeoff. In all our conversations from Monday, we're talking about this week as arguably being the most important week for risk assets because it's the week of Fed speak and it's the week of budget, and in India in particular, while the question mark remains about whether this is a vote on account, if the 2019 experience is anything to go by, this may be a lot more than that. Who better to put all of this into perspective and the budget math into perspective than Pranjul Bhandari of HSBC. Incidentally, HSBC has also come out with India's first flash PMI numbers, so we'll talk a bit about that as well. But Pranjul, great having you. Thanks for taking the time out. I'm just trying to understand whether you believe that this could be a budget which could dwell a lot more on fiscal consolidation, and therefore do we see some moderation in the impetus that the government has hitherto given in the past few budgets, predominantly on infrastructure and capex, but maybe to some other areas as well?
Yes, I think I agree with you there, but it's in line with what the government has been talking about in the last couple of years. It's not just something only for this year. I think the general sense of this government is not focusing on the volume of spend, but the quality of spend. So our sense is that they'll bring down the fiscal deficit in line with the consolidation path this year and then next year again, and overall they'll bring down the overall expenditure as well. But within that overall expenditure pie, they'll improve the quality of spend, moving away from current expenditure more towards capital expenditure. I think that has been a theme of this government, and it will continue to be so. Fiscal discipline, fiscal consolidation, but high quality of spend.
Okay. Pranjul, when the last budget came out, I remember you were amongst the first ones to talk about this quality of spend, about the fact that the government has not doled out freebies, but instead spent money where it still benefits the rural household, but results in capex. So my question is, will we see moderation of any key capital expenditure, nation building related themes, or do you think both can happen parallelly? Because I was trying to think of avenues for revenues, and tax revenues being there, yes, but disinvestment revenues have largely been absent in this fiscal. So how does it augur for FY24? And will there be some material references made to FY25 numbers, or do you reckon the best will be kept for July?
Well, look, my sense is that whatever budget we get on the 1st of February is largely the budget for the year. You know, I don't really foresee too many changes when we see another budget in June, July. And the big reason for that is that there are very limited contours that the central government has to fiddle with. It has to bring down its fiscal deficit from 5.9% in FY24 to 4.5% by FY26. This is the middle year, so it will bring it down to perhaps 5.3% of GDP. So when you're bringing down the fiscal deficit, you don't have space to do too much extra spending here or there. My general sense is that in FY24, capex spend was 3% of GDP. In FY25 also, it will stay about 3.3% of GDP. So unchanged capital thrust. In rupee terms, there could be some increase. So from 9 trillion to 10 trillion rupees, you know, between FY24 and FY25, which is about a 10.5% year-on-year increase. So this is still a very good number at a time, you know, when fiscal deficit is coming down, even though it's not as good as the last few years we've been seeing, closer to 30% year-on-year growth in capex. So I would say they'll maintain capex thrust, but they can't accelerate it at a time of fiscal consolidation. But I just want to take a step back here. Actually, the real story of FY24 wasn't central government doing capex. The real story was state governments doing capex. And a lot of people miss that out. You know, state governments which were literally not spending, you know, in the pandemic and the 1 or 2 years after pandemic, suddenly started spending in FY24. And capex spend rose 45% year on year. Very strong numbers. And I think that has been a huge source of growth, particularly construction jobs, particularly rural demand over the last 12 months. So we should always think of capex as center plus state combined. And if you combine the two, my sense is we are at our best in terms of growth rate right now. Next year, the growth may not be as high, but in terms of percent of GDP, the thrust will be maintained.
Got it. And absolute numbers also might look okay. Okay, Pranjul, maybe I thrust a few things that were top of my mind at you at the start. Let's try and understand what is it that you are watching out for the most when it comes to Feb 1st?
Well, a lot of things, as in, of course, the fiscal consolidation path Still, there are pockets who say that there will be some slippage because this is a pre-election year. That is not our base case, but again, we'll have to watch out for that. That how well the government sticks to its 5.9 for FY24, and next year does it really bring it down to 5.3, or does it go with slightly higher fiscal deficit like 5.5? So I think one would be this. The second, which I think the bond markets will be really focused on, is the amount of borrowing that the central government will do. See, if you're going to bring down the fiscal deficit, then your borrowing also, should come off. And if it comes off in a meaningful way, then I think that will be very positive for the bond market. So my sense is bond market is thinking about a 15.2 trillion borrowing in FY25. If it's any number which is lower than 15.2 trillion, and there are some ways that can happen, if RBI and the government do switches, then I think that will be extremely positive for the bond market. I think that's something we want to hear about. And the third is capex. The BE, the budget estimate for FY24 was 10 trillion. We think they'll end the year slightly lower at 9 trillion. What is the BE going to be for, FY25? So, I'll look out for these three. But again, I think we have to also look at state governments, and I'm sure we can talk about it later. We have to look at what RBI will do, after the budget is over.
Yeah, so I'll come to the RBI in a moment, as you said, but since you've dwelled upon the state government part a couple of times already, I'm just trying to understand, in terms of numbers, you laid out the broad-based numbers, but is this something that came as a bit of a surprise to you as well? Because as you said, post-COVID, there's a bit of a pause. And does this, in some sense, Pranjul, give a bit of a leeway to the central government in its budget? Because hitherto, the hope was that, okay, post the central government doing the capex, private capex hopefully will pick up its mantle. While that didn't happen, if the state government capex is very high, in some sense, does that come at a bit of a helping hand to the central government when it makes the budgetary allocations?
Absolutely. As in, if you look at only the central government, then increasing capex by about 20-25% year on year in FY24 was meaningful, but maybe it would not have been meaningful enough if you think about the backdrop. The backdrop was an El Nino year. The rains were not good. Rural crop production wasn't very good. Rural incomes were not very good. And I think the fact that the state government zoomed in with such huge capex spending provided all of this construction activity around the country that many rural Indians who were not able to make much money out of like sowing activity actually just took off for the construction sector. And you can track this data. The Aadhaar enabled payment system, AEPS, tracks rural remittances from urban India to rural India. And that has soared, quite meaningfully from September onwards. So there has been some helping hand to rural incomes on the back of, this capex, which is, an ideal thing for a pre-election year. So this has been a good backdrop. And I think that is one of the things which has not put so much of pressure on the central government to do some rural SOP, to do some rural scheme. True, we may find some small scheme announced on 1st of February, but my sense is that it's not like, a government that is dealing with rural distress in a big way.
Yeah. Okay, so two questions that I have. I'm trying to think which one should I ask first. Okay, let me ask this rural question first, because the last time that we spoke, you mentioned that at the margin, in some parameters, you had started to see some positivity in the rural income / rural spend, as the case may be. And it was not all bad at the rural end, the way the market was perceiving. I believe this was a conversation that we had sometime in November, Pranjul, if I'm not wrong, or maybe early December. I would love to understand from you this belief that some quarters have that the government will have to or will go ahead and do some spends on the rural side. They shied away from it the last budget. Do they really need to, or do